we can kind of map all those things out and create a way that you can have where your assets go where you want them to go, which is probably not into the coffers of the IRS.
We're talking about escaping the crisis of liquidity with your estate by planning now, making exits now, so that you're outside the taxable estate, one, but also so you have harmony and I guess freedom to not feel like the kids or the heirs are going to have to really make tough decisions that can cause friction between relationships. And so let's walk through step one. Step one would be identifying how much is inside your taxable estate, number one. Step two would be, I think, even before this, what's your vision? What's your plan? What's the legacy you're hoping to leave with your wealth? So what does that look like, right? Fast forward, it's 10 years, 5, 10, 15, 20, 50 years after you've passed away. What are you hoping to have accomplished with the 10, 20, 50, 100, $1 billion worth of wealth that's passing to the next generation? And of that, how do we financially be great stewards, help you to be great stewards with that wealth? And how do you escape some of these crises that are looming? Okay, well, enter the DST plus. Okay, so you can list and sell an asset today while you're still alive. And this is so key, because while you're still alive is the key determination if you can get it outside of the taxable estate before the triggering event, which is your death. Okay. And so we can sell today, and let's just say hypothetically it's $100 million worth of commercial real estate property in California, New York, New Jersey, business, it's cryptocurrency. It's something that's highly appreciated. And upon that exit into the DST plus, you now receive a promissory note back. So let's say it's 100 million, you're owed the 100 million plus a rate of return. But the key is, because if it's in the DST plus, we're outside the taxable estate. Not only are we outside of that 100 million as of that date, but also that growth of that. And so if you're still like, hey, I'm not even thinking about Deferred. I'm very young and healthy and all these things. And I have many, many more decades to go. Fantastic. Because not only is the 100 million outside now, but also the growth of that. So let's imagine you're an entrepreneur and you're like, okay, great. I just sold $100 million. I'm in my 30s, my 40s. I have many years for this to grow. And this grows to $1 billion over your lifetime. Guess what? All of that is outside of your taxable estate, which means what? It's not subject to the 40% death tax. Joe, you want to add, subtract, or highlight anything I just said there?
I mean, it is absolutely true. The appreciation is often forgotten about, right? It's like, I got to take care of this amount today. Well, it's like, well, we're going to appreciate this asset over time. And all of that is exposed to this tax. And it's not just the 40% federal. You're talking about a state, a California, a New York. Some of these states can be brutal as far as adding on top of that, this 10%. And not only that, but you also have the cost of administrating and exiting that estate. So having it pre-planned out with a DST plus allows it all to be pre-planned. It just continues to flow into motion, passing down generationally. So I think this is critical for people to consider and to think about. And it's in combination with a number of other strategies and tactics that we'll discuss. So, there is a legacy for the children, a legacy for your charitable desires, for your business, whatever it is. We can kind of map all those things out and create a way that you can have where your assets go where you want them to go, which is probably not into the coffers of the IRS.